afternoon, at least for those of us on the East Coast, it's afternoon. I'm James Ledbetter. I'm the Chief Content Officer of Clarim Media, which is the parent company that owns Worth Magazine, as well as a couple of other things. And welcome to our session today on alternative investments. Let me start with some quick introductions in alphabetical order. First, Jim Baird is a partner and Chief Investment Officer at Plante Moran. Jim, welcome.
Thank you. Great to be here.
And then his colleague, Doug Coursen, is a principal at the same firm. Doug, welcome.
Thanks for having me, Jim.
So a couple of housekeeping notes before we start. It's, a Thursday in August, and we're going to try to be very efficient and not make too much demands on people's time. So we're going to wrap this up in by the 45-minute mark. So at 1:45 East Coast time. And in line with that, we have found with these virtual events that instead of waiting to the very end to ask a Q&A session, it makes more sense for the flow to just ask the questions during the session as they come in. So we very much encourage you all to submit questions. You can just put them in the chat or raise your hand, and if we think the questions are worth talking about, we'll deal with them right then as they come in. So Jim, let's start with a little economic history. How do we get in a situation where, let's say, a relatively risk-averse investor is now thinking, wow, I really should be considering alternative investments?
Well, it's a great question, and it's been a long story to get to this point. Really, I think you could take it all the way back to the 1980s. When inflation peaked in the early 1980s, the Federal Reserve took aggressive actions to raise interest rates, raise policy rates to try to break the back of inflation, which was ultimately successful, resulted in a difficult recession there in the early 80s. But since then, we've been in this secularly declining interest rate environment. And it extends not only to the United States, but also you're seeing that dynamic globally without question. Some of the other underlying causes, though, are meaningful, not only in terms of the rate environment, but the broader economic outlook as well. But you think about those other dynamics, certainly the aging demographics here in the United States, the greater propensity to save in part in response to that. You're seeing a global savings glut. So there's no shortage of dollars chasing safe capital or safe investments to try to eke out some yield. And so I think you look at those types of factors, and it helps to explain a lot of it. And then the last piece, of course, is the fact that the growth environment looks very different. Economic growth has been slowing over a secular time frame and is expected to continue to remain low, in part because of those demographic factors as we move forward from here. So lower growth, lower inflation would tend to lead to lower yields, and that's where we find ourselves.
So lower economic growth, at least until quite recently, right? Because of the stimulus package and the kind of post-COVID. It turns out we got out of the recession while we thought we were still in it, and sometime in 2020. But talk a little bit, if you would, about bonds and the role that bonds have traditionally played in a typical kind of balanced portfolio, and how they look now.
Yeah, absolutely. And when you look at bonds, most people tend to think of them as a source of income, and that certainly is a key consideration. But it really isn't the only role that bonds play in a portfolio. For most investors, it's a significant source of risk mitigation. If you assume that the equity part of your portfolio is going to be the primary driver of growth over the course of time, you want some sort of counterbalance there, because that growth doesn't come at no cost, right? There's a risk element to it in terms of volatility. And so for most investors, the right answer isn't to be 100% invested in equities at all point in time. You need something else to mute that risk. And bonds are an excellent way to do that. So it's a source of diversification. It's a source of liquidity. Bonds are also a source of relative risk reduction, but that yield component is an important piece for many investors. And that's the part that really, I think, is particularly challenged today.
Yeah. So before we start talking about specific alternative investment strategies, I'd really like to get more of a sense about how the firm, how Plante Moran thinks about these investments. And I should say, for those who don't know, Plante Moran is one of the largest advisory, accounting, and wealth management firms in the United States. And Doug, my understanding is you head up the firm's alternative investment committee. Talk a little bit about it. What does that mean? What is an alternative investment committee? What do you talk about? And
Sure.
how does that committee relate to the rest of the firm?
Sure. I would like to think that I head up the Alternative Investment Committee. Alas, I am just a voting member.
Merely a participant.
But I appreciate the promotion. So really the alternative investment universe has grown substantially post Great Financial Crisis in 2008. And when you look at kind of the transformational shift of that market, I think going into 2008, it was a very kind of esoteric and shadowy market where it was, categorized by high minimum investments and hard to access. And we've really seen just, I would say, massive growth in the availability of alternative investments for many, many more investors. And so there are still obviously, restrictions on who can invest in alternatives, whether it's qualified purchaser status or accredited investor status. But there's been a huge kind of, I would say, wave of access for investors these days. And so, as a firm, we had basically said, okay, our clients, can access these investments. Our clients should be accessing these investments, and our clients are going to, be brought these investments through their, their connections and their friends and colleagues that they have. And so, given some of the additional complexities that come along with alternative investments, really said this is, we have at Plante Moran, we have three committees that kind of make up our research function. We have an overarching investment committee that makes all kind of final decisions and sets policy for the firm. And then underneath that, we have a research and an alternatives committee. The research committee had always been there, but really in kind of I would say the early 2010s, we said, hey, look, this is an expanding market. There are a number of different considerations that go into alternative investment due diligence and sourcing. And so we want to set aside a committee that's going to focus on that. And so we have an 8-member committee, half internal research folks, half client-facing folks like myself, who are working with individuals that have access to and have used these types of strategies for many, many years. And so that committee is really in charge of, the ongoing investment strategy, due diligence, research, and a lot of it, I would say the big kind of delineation in alternatives is a focus on operational due diligence. And so everyone kind of thinks about, traditional investment due diligence where you're looking at things like historical performance and, things like that. Whereas in alternatives, there's a lot of risks. We all know the big names like Madoff and things like that. Well, those were all alternative strategies. You have, a lot of times you have less oversight and monitoring of these types of strategies. And so we spend a lot of time on the operational side of things to help our clients avoid pitfalls like Madoff, like MF Global, things like that, where, basically, your entire sum of money has been lost and subject to risk. So that's the committee. And we kind of, we have an active list of managers and strategies that we recommend, and it's ever growing and something that we monitor on a daily basis here.
And are the committee's decisions and deliberations strictly for clients, or are you also advising the firm itself about how to invest its own assets?
Both. I would say it skews largely in favor of clients, probably 90-10, I would say. We do have a separate and distinct real estate group within Plante Moran that focuses entirely on real estate investments. And so that's not the charge of this committee. This committee focuses more on things like hedge funds and private equity and things like that. But it's largely client focused. Again, pushing out recommendations to clients, offering solutions to clients, but also helping them evaluate opportunities that they themselves have from their own investor and kind of personal networks.
Got it. Okay, so let's talk about some of the alternative strategies that people are considering or actually pursuing. Jim, you wrote a piece recently for Worth.com in which you listed a few options that are available to those who are, seeking higher yield than they might be getting. Of the ones on the list, I think the one that was the most familiar to most readers would be real estate. Now, personally, beyond the condo where I live in Manhattan, I have never invested in real estate. Aside from fantasies about beach houses, I've never really thought about investing in real estate. I wouldn't know how to do it. What would make that an attractive investment to a typical investor who might otherwise just be in stocks and bonds and ETFs?
Well, real estate is a pretty diverse asset class, as you already alluded to. You can come at it from the standpoint of your personal residence or investing in some sort of, second home, perhaps. We tend to not think of it that way, though, because we're thinking of it in part as an income generating asset. Now, certainly
Right.
you could own a home that you're renting out. But when we think about really investing in real estate, it's in more of an institutional context. Hiring a professional manager to, in turn, construct a portfolio of diversified properties. And when we think about diversification, for the most part, we're talking about both geographic diversification, because you recognize that if you're over concentrated, even in a certain part of the country, it might be a region that is booming, or it might be a region that's struggling. So geographic diversification comes into play, but also diversification by property type, recognizing that there's a whole host of different property sectors: industrial, warehousing, retail, multifamily, hospitality, hotels. So there's a lot of different ways to play it. And at any given point in time, one sector or a couple sectors might be doing fairly well, and others might not look quite as attractive. That's certainly the situation we find ourselves in today.
Yeah. Yeah, I want to talk a little bit about that. But what's the channel by which people are making this investment? I'm guessing you don't tell somebody, hey, here's an acre and a half of land, go buy it for $25,000 and you'll get, a 50% return over 10 years. I'm sure it's much more complicated than that. Can you talk a little bit about how you slice and dice these investments in order to achieve that diversity goal?
Absolutely. And as Doug alluded to, we actually have a separate group in Plante Moran that does this 100% of the time, but we're collaborating with them constantly on a number of clients that would have significant real estate holdings. There's a few different ways that an investor could access a real estate type investment. For most investors, the easiest way to do so is via publicly traded REITs, either ideally through a mutual fund or an ETF.
So that's a real estate investment trust.
That's correct. The key differentiator, though, is that if you're investing in a REIT or a real estate investment trust, mutual fund or ETF, they're in turn buying stocks. So what you're really buying into there is a subsector of the broader US equity market. So while you're getting some exposure to real estate, the correlations there to traditional equities are going to be quite high. So I don't think you get the same degree of diversification benefit that you can get if you're able to invest directly in real estate. Now, that requires, in most cases, additional capital. The minimums can be much higher. The lockup periods can be much higher or much longer. So there's a lot of additional considerations. But that's where I think the investor who has the ability to commit that kind of capital for an extended period of time gets the true benefit of real estate, which comes in a couple forms. Number one, obviously, the main thing we're talking about today is the search for yield. And developed real estate that is leased out can generate a nice income return for the investor over the course of time, while also providing the opportunity for capital appreciation as the value of those properties increase over the course of time. Of course, that means, again, having a skilled, qualified manager who has the ability to make some of those determinations, to evaluate the market, to identify attractive opportunities, and to determine how to structure a portfolio that will reduce the property-specific risk and really try to give broader exposure to the asset class.
Got it. Just a reminder for our attendees, we welcome your questions. You can either raise your hand and we can call on you personally, or if you prefer to just submit it in the chat, go ahead and we'll read those as they come through. Jim, you mentioned, and Doug, I'd like you to jump in on this as well. You mentioned that different parts of the country, their real estate markets might be performing quite differently than in other parts of the country. And I think a lot of us have seen, to some degree, surprisingly, big jumps in local real estate markets. I think I was looking recently at, it was either Dallas or Houston, and it was some, like 50% increase in the median price of a home sale in just a year. Is this a really tough time to be investing in real estate, or is this a great time to be investing in real estate because we're seeing these kinds of returns, or these kinds of price hikes anyway?
Well, I would differentiate between residential and typical real estate investment. And when we're talking about investing in real estate, for the most part, it's going to be the commercial side. To your core question, though, my answer is going to be a little nuanced. I'd say it's neither a bad time or a great time, but I'd say that for an opportunistic manager who is well connected, who has the ability to evaluate individual markets and property potential, there are opportunities out there. But I think it's much like the rest of the market. There are not a lot of areas that I would consider to be fat pitches today. There's a tremendous amount of capital that's been deployed. You see the rally that we've seen in stocks. You've seen it, elsewhere in the market as well. So I think you have to pick your spots, but I think aligning with a very resourceful manager who has demonstrated the ability to make those determinations is the way that we would typically recommend somebody approach it.
I agree with you, Jim. I think one of the key considerations is really understanding what is your risk return trade-off. And so like Jim said, there's 100 different ways you can access the real estate market. It's no different than private credit or structured credit or anything like that. It's same scenarios, understanding what risks are acceptable for your portfolio. So for example, are you willing to trade, say, liquidity? So if you're a young investor who's investing in for your retirement, that's 20 or 30 years off, you can probably afford some illiquidity in your portfolio. And so as a trade for that liquidity, can you earn a higher yield? Can you increase your appreciation opportunities? Yes. And so things like that come into play. Understanding how much leverage your real estate manager might be using. Is this a portfolio that applies leverage around the edges, or that applies 3 turns of leverage to every investment they're making? Understanding kind of what kind of risks you have, what that means for your potential return, and layering that into your overall asset allocation, because all of these things kind of play a role in understanding where you're taking risks and how you're being compensated for those risks. Because in like Jim said, to allude to kind of the topic of this conversation, in a yield-starved world, when you're looking to add yield, or you're trying to chase yield, the only way to add yield to your portfolio is to increase risk. There's 20 different ways you can increase risk, but you have to understand which of those types of risks are acceptable to you, and kind of how the manager interlays those risks into their strategy and how that fits within the context of your broad portfolio.
Yeah, it's a great point, Doug. And the one thing I would add to that is, depending on where that tolerance level for risk is, the range of opportunities in the real estate space is very broad. Jim, to go back to something you alluded to earlier, buying raw land, that's not a cash flow opportunity necessarily. If you're looking for yield, that's not where you're going to find it. But there may be long-term appreciation potential to develop attractive land and kind of start from scratch, or in distressed real estate for a skilled manager to come in and turn something around. But that's not about cash flow or yield. That's about longer term appreciation potential. So if your focus is really on how do I improve the yield of my portfolio, you're talking more about looking towards a core oriented portfolio of leased properties that should provide a little bit more stability in that regard.
I definitely want to come back to the risk question a little bit later, but just sticking with real estate for one more question. I think I have a good understanding of how a REIT works. I mean, I think I buy a REIT very similar in the way that I would buy a stock or a mutual fund or an ETF, but the kinds of investments that you're talking about, like what is the market mechanism? What is the actual channel that the investor goes through in order to make those kinds of investments?
Typically is going to be in the form of a limited partnership.
Got it.
And so again, it comes back to being qualified to be able to purchase into the limited partnership. There's a whole host of flavors, but it's that trade-off that Doug alluded to. In order to achieve that greater yield potential, the manager has to know that they can lock that capital up for some period of time. That can be done via limited partnership, whereas with a mutual fund, obviously the need to have daily liquidity really constricts what can be done.
Right. Okay. That makes a lot of sense. So, Jim, another category that you put into your article about possible alternative investments was what you labeled high yield opportunistic credit. And I think I've been around long enough to remember when that was called junk bonds. How does that work, and why would that be an attractive investment for, again, a typical investor?
Well, again, I think when you look at the environment we're in today, you've got that trade-off between quality, between liquidity, between risk and yield. And if you want to maintain the maximum amount of liquidity, you're really constrained, and quality, so to mitigate your risk, you're really constrained to an opportunity set that is going to carry a yield that's going to be quite low. I think the 10-year Treasury is at around 1.2% today. Obviously, we know what we're getting from cash, which is next to nothing. And so if you want to stay in the broader fixed income market, you have to move out the risk spectrum to find places to, collect a little bit more in terms of income. High yield is a space that can provide a relatively attractive yield relative to high quality. If we were to go back to March of last year, we know obviously, the world was kind of falling apart in terms of it didn't matter where you were at. The Fed ultimately stepped in to provide stability even to the Treasury market. But high yield spreads, corporate spreads blew out. So we get through that most difficult period in March. And even as we saw a bit of a resurgence in equities that extended obviously through the rest of the year, high yield was pricing pretty attractively at that point as well. Spreads over treasuries up around 1,000 basis points or 10%. So a pretty attractive opportunity there on a relative basis. Now, what we've seen in the intervening period, not surprisingly, is that capital has moved into risk assets. Equities have benefited, real estate has benefited, high yield bonds have also benefited. And so spreads aren't nearly as wide as they were. In fact, they're back down to comparatively tight levels. But if you think about it in the context of where do we go from here, if you believe that we're still relatively early in the economic cycle, default levels are relatively low. There's a tremendous amount of positive momentum in the economy. Corporate revenues are up, cash flows are up. Even those companies that might not be investment grade present some opportunities. And I would say this: when you're sitting here today as an investor and looking forward, many are concerned about interest rate risk. If the Fed starts tightening here at some point, you see the traditional Treasury or high quality corporate market impacted by that. Rising yields, that's a negative in terms of total return. And while high yield debt can also be impacted similarly, the duration or sensitivity to rising rates is much lower. So you're trying to find that trade-off between duration or interest rate risk and credit risk. And again, early on in the cycle, credit risk should be somewhat mitigated. So we wouldn't recommend certainly taking the entirety of your bond portfolio and moving into lower quality credit, but having a measured allocation there to supplement that high quality core is a nice way to maintain an overall defensive posture, or the ability to diversify away your risk assets, most notably your stocks, but enhance your yield at least at the margins.
Yeah, that's actually a good opportunity for me to remind our viewers that this is a discussion about strategies in general, about different kinds of asset classes. This is not specific investment advice. Jim and Doug obviously give advice to the firm's clients, but none of this is meant as specific investment advice to anybody who's watching. But sticking with the high yield bonds for a moment, is the best way to get exposure to those spreads to buy the individual bonds themselves, or are there securities that are easily obtained that kind of pool these bonds together and allow you to take a bite of the market that way?
We would absolutely be huge advocates for active management in this space. So in doing so, you're able to reduce some of that idiosyncratic risk that can come with buying an individual security. I will tell you that security analysis and understanding the fundamentals of the company in a space like this is critically important.
Right.
Would not be an advocate for individual investors going out and picking individual bonds, but leave it to a qualified manager who's monitoring the markets every day, who can see those relative opportunities, who has the depth of expertise to do so. Plenty of options in the traditional mutual fund space that can provide that type of opportunity. But I would also say, and it kind of leans into the second part of your initial question, as we look today, recognizing that high yield is not as attractive as it was, say, a year ago, I would say broaden the net a little bit as well. And that's where that multi-sector opportunistic type approach comes in. Think about a manager who has a high yield mandate. They can pick and choose from individual securities within the high yield universe. And again, I think there's still opportunities there, but it's a narrower mandate than an opportunistic multi-sector type manager who can look at high yield. They might look at emerging market debt. They might look at agency or non-agency backed mortgages, or any number of other parts of the market, and really pick and choose where they see opportunity at a given point in time. So it takes that actively managed component to the process and just amps it up a bit.
Interesting. Doug, you mentioned one area that was also included in Jim's earlier article, which is private credit. That to me means nothing. Like if somebody is lending somebody else,
as it should.
if somebody's lending somebody else some money, how would I begin to invest in that, and why would I want to?
For sure, and private credit is, because we have to give it a name, I guess. So we'll call it private credit. A lot of this, again, is focusing on the structure of the investment vehicle. So like Jim said, not necessarily in this case a mutual fund or an ETF, but a private limited partnership that you're investing in, and the manager who is investing the funds for you is not necessarily investing in public market securities. There's a whole host of things that you could consider private credit. You could consider things like, a structured credit hedge fund as private credit, where they're going in and they're buying asset-backed pooled securities, looking to add yield for their investors through more esoteric security selection. You could be talking about direct lending strategies. Direct lending strategies has been a huge growth area in alternative investments post financial crisis.
And what does that mean, direct lending strategy?
Yep. So post 2008, banks basically moved out of the lending space to middle market companies. And so large companies, S&P 500 companies, can still access public debt markets. They can go out and they can issue their own debt. But a lot of these institutions that want to borrow that are, $50 million to $1 billion worth of revenue, call it this sort of middle market, which makes up 45% of our economy, really kind of lost access to credit markets and lending markets. And so you had these private institutions step in and say,
we will provide. What's called the shadow banking industry.
Sure, lump that in with the junk bonds as well as things.
They do have somewhat negative.
Things we don't like to call it anymore. Exactly, but the credit underwriting is part of the due diligence, and so understanding how these managers are going through their underwriting process, how many deals they're looking at, on a daily basis. One of the direct lending managers that we work with looks at over 3,000 deals a year and does maybe 15 of them. And so there's a lot that goes into it, but basically they're just making loans to middle market companies, not necessarily even levered companies or high yield companies or junk companies as we don't want to call them, but basically just private loans to companies with strong balance sheets and things like that. But because you're on the private side, because you're sacrificing liquidity, and because you can't turn around and go and sell this position tomorrow, you earn a higher yield. In addition, because it's a private security, the manager can apply leverage. And so, so think about a high quality $1 billion company in the direct lending space. You could be looking at yields north of 10% for a loan there, whereas in traditional public markets, a AAA rated corporate is paying you 3% right now. And so it's all about kind of this: what are you willing to sacrifice to attain some level of enhanced yield?
And again, so the mechanism there is we have our $1 billion company, our Widget Inc. There's some entity that's a limited partnership that has put $50 million into this widget Inc. And the mechanism for an average investor like me would be to invest with a limited partnership and get some slice of that 50 million.
Exactly. Buying into this pool of loans. And so, there are other kind of distinct advantages, kind of why we like the direct lending space right now. A lot of these loans are floating in nature. They tend to be shorter duration than traditional kind of high yield bonds. So if you look at kind of the duration of a high yield index right now, it's probably north of 7 years. Whereas a lot of these direct lending strategies can keep maturities, between 1 and 4 years. And so there's some distinct advantages there. But again, you have to understand who you're investing with and make sure that, you're investing with the right strategy and figuring out, are you being compensated for your additional risk? Because there's plenty of these strategies that, when all is said and done and after taxes are applied, because remember, a lot of this stuff is flowing to investors as ordinary income. Right. After taxes are applied, you're looking at returns that are mediocre at best. And so it's really important to kind of focus on who you're investing with and how you're investing and kind of how that fits within the context of your portfolio.
Yeah, the tax consequence thing is really interesting. Are there areas in that private credit sphere where you can come in with some kind of carried interest and get a tax preference that way, or is that a whole other category of investment?
Yeah, not typically. The carried interest is usually typically falling to the general partner as opposed to the limited partner. Right. There are different ways to access these strategies. And so a lot of these limited partnership vehicles will have both onshore and offshore strategies. And so without getting into the complexities of that, you can invest through a tax deferred account like your IRA. And so you can avoid some of these taxes. Obviously endowments, foundations, things like that are paying, little to no tax as is, that's not a concern for them. The typical Plante Moran client is a tax paying client. And so we spend a lot of time understanding what are the tax consequences. That's part of the reason why real estate has been so compelling, we think, is because you are getting typically a preferred return on, a preferred, pre-tax return where you're getting some kind of return of capital or 20% REIT deduction on your tax return. So there's a whole host of tax analysis that goes into all of this as well. And it's one of the risks that you have to be aware of is, what are the tax consequences associated with making these investments?
And
Jim,
Doug, to add to that, I would say that, and that is a critical part of the discussion that is so often overlooked. It is really easy at times as an investor to get caught up in a projected rate of return, or even the actual nominal rate of return that you achieve off of an investment in the portfolio. But looking at it after the tax costs is really a critical part of understanding. Is there an opportunity there, or is there an opportunity that is not nearly as great because much of that incremental return is being chewed up in tax liability? So that's something that we would go through anytime we're trying to analyze whether or not, whether you're talking real estate, credit, and any piece of the portfolio, does it hold up after you consider that tax drag?
Yeah, that seems critically important. Jim, in your article, one of the categories that surprised me a little bit is insurance. And when I say surprise, it's just because I think of insurance as a kind of highly regulated, somewhat stodgy space, that the idea that it's going to yield an oversized return just struck me as non-intuitive. So can you talk a little bit about insurance products and how they fit into this higher yield environment?
Yeah, I'd be happy to. And I'd be remiss, and I'll just use this as a moment to also acknowledge the role that Doug played in preparing the paper, and also one of our senior alternatives analysts, Jeremy Kedzior, who did a phenomenal job helping us pull together all of these topics. But insurance is a little bit of an outlier in the context of the other things that we've talked about. And I think, you have to be careful. Just as we would say in any of these spaces, active management in the credit space, in the real estate space, in the high yield space is critical. in the context of insurance, it's understanding the range of products that are available out there, because not all products are created equally. Not all are attractive. In fact, some you could make a case really are very unattractively structured. But there are times when a particular structure comes along, particularly in the universal life space, where you may have the opportunity to, if you're willing to lock up capital for an extended period of time, just like with many of the other things we've talked about, to achieve a rate of return that would exceed what you could get just in the traditional bond space. So and the way that they do that is through investing a portion of the capital that you pay in the premium in a separate account. Part of it goes to pay the life insurance premium, then part is in turn invested. Typically, the bulk of that would be invested in high quality securities, but they're also able to employ leverage through options to get exposure to the equity markets. And in doing so, in a given year, the investor, depending on the terms of the product, can participate in equity upside and perhaps limit the downside, or perhaps have a floor under it that effectively limits it to zero. They can be very complex in terms of how they're structured, but the ones that we've run across that can be attractive at times sort of follow that logic. So you participate in a certain amount of upside, perhaps capped at 8, 9, 10% of the equity markets in a given year. And so if the equity markets return 15%, let's say the S&P 500 is up 15%, you might still only achieve 8% of that return. Right. If the markets are down 5%, your basis doesn't or isn't reduced. If it's in between, then you get participation in there. So over the course of time, the expectation is, as we analyze these, that you can get to a rate of return often over 6, 7, 8, 10 years that is going to exceed what you're able to pull off of bonds at this point. So, but again, this is an area where I can't stress enough. You really have to be very careful. You have to understand the product. And for the clients that we work with, we're doing the analysis to help them evaluate whether or not there's a place for that in the portfolio.
I want to back up for a second, just because we have a question from the attendees. Direct lending funds private equity deals typically. Lenders are smaller entities, not large institutions. Are returns from direct lending really available to the average investor who can't invest in a PE?
Yes, that's a really good question. And the author of the question is correct. A lot of times, the direct lending are to private equity sponsored companies. I would say there are ways to access the market for kind of the typical average investor. It just won't be as direct exposure. And so you can invest in, through things like, an interval fund. An interval fund is kind of a mix between a limited partnership and a mutual fund, where you are giving up some liquidity. So instead of being able to sell on a daily basis, you can only sell on a quarterly basis. And so there are things that the managers of those types of strategies can do, and direct lending would fall into something that an interval strategy manager could do. And so there are ways. You just might not get 100% of your investment into a direct lending strategy through that. But there are methods and ways to access that. But it is difficult without being able to access some of these private vehicles sometimes.
Jim and Doug, when we had our prep call, I predicted that we would get a question about crypto, and indeed it came in at the 16-minute mark. Do you consider crypto an alternative investment, and how do you advise one of your clients who comes to Plante Moran and says, I really am, dying to get into Bitcoin or Ethereum? How do you evaluate those investments?
Sure. And I would say yes, cryptocurrency is an alternative investment. I would say it is the most alternative investment, if you would allow. As it pertains to this phone call, cryptocurrencies are not a way to generate yield for the portfolio. Cryptocurrencies don't pay dividends. There's no interest that comes off of cryptocurrencies. And so for the purpose of kind of the topic of the phone call, cryptocurrencies would not really be an alternative solution we would look to. That said, I don't know that there's ever really been an asset class that has ever existed out there that it's so easy to make both the bull and the bear case for it. in terms of where I think it could go. And so, like every other RIA out there, our clients are interested in these types of investment strategies. And so, again, it's about understanding what the risks are with it. And at this point in time, cryptos are kind of the ultimate risk asset. You see price movements that even on some of the most stable of the cryptos that can go from 20,000 to 60,000 back down to 40,000, and in the course of 2 weeks or even over a weekend. We've seen a bunch of cryptos blow up. Mark Cuban had the Titan coin or whatever I think it was that basically went from 0 to 5 cents to 0 and lost all of his money on it. And so it's about managing risks and understanding what risks you're willing to take in your portfolio to achieve return. You can invest directly in cryptos through platforms and have your digital wallet. You can invest through funds. There's been a lot of talk, especially this week, as the SEC kind of lays out the laws and the rules for what I think will ultimately lead to US-based Bitcoin and Ethereum ETFs and things like that. And so it's on the horizon.
Yep.
Definitely not, like I said, not for yield-seeking investors, but for sure those that are interested in high risk, high return markets, something to consider. But appropriately sizing in the portfolio, I would say, would be paramount in this asset class more than any other I can think of.
Yeah, I should note there are for those of our in our audience who might be eligible, there are at least I think 2 Canadian Bitcoin-based ETFs.
Yep.
The US SEC is still holding out. Although I agree with you that I think that is very much on the horizon. We only have a couple of minutes left, but I want to come back to this question that has come up repeatedly, and that is about risk and return. When you think about alternative investments, is there a rough cap that you would tell your clients, like, don't invest more than X% of your portfolio in an alternative investment? That's question number 1. And then question number 2, are there any assets that you've ever presented to your clients and had the clients go like, nope, no way, that's crazy, like no one will take it? I'm just curious.
Yeah, I'll provide some perspective, and Doug, feel free to weigh in.
Yeah.
I think it's safe to say that the decision to allocate to alternatives is very unique to every individual. And for many clients, for many investors, it's completely inappropriate. I'll be the first to say, and we've talked a lot about active management, we've talked a lot about alternatives. I think there's more than one way to achieve success in terms of the development and implementation of your portfolio, but you've got to be true to yourself as a starting point, and having a strategy that you can stick to over the course of time, whether it's active, passive, whether it involves alternatives or not, that's paramount. In terms of how much to allocate to alternatives, we have many clients that don't put any assets there, and appropriately so. And certainly we have some that might allocate upwards of 30, 40, 50%. Wow. But you're talking about individuals with extremely high levels of tolerance for risk, with extremely long investment time horizons, and adequate liquidity to meet their needs and objectives that allow them to lock up capital for a big piece of the portfolio for an extended period of time. In terms of the second part of the question, obviously we want to be very thoughtful about what we take to clients, regardless of who it is. But because we recognize that not even good ideas are not necessarily a fit for all clients, absolutely, there's times that we walk through ideas with clients and present the pros and cons, and they decide to pass. So it really is an individual investor decision.
Yeah, and that's part of kind of, I would say, the benefit of the structure and the way that we have it. And so Jim, for your reference, when our alternatives committee rolls out a new strategy for our clients, it's presented to client service teams first. It's presented to advisors like myself. First, we get a chance to interact with managers and ask questions, and then it's folks like myself's responsibility to say, okay, I have this option here. Which of my clients do I think that this is appropriate for? And so not every alternative investment that gets approved by our committee is presented to every single client because it's not appropriate. Right. And I have for sure had clients tell me no. Luckily, no one's called me crazy yet, but I've for sure had clients that have told me no, but that's okay. It's about presenting the opportunity set and saying, this is the investment opportunity that we think exists. And the reality is that we think an alternative structure is the best way to access that. I will be the first person to tell you that it is inappropriate to invest in alternatives for the sake of investing in alternatives. I can't tell you how many clients come to me from other institutions and I see their portfolios and I say, okay, well, why do you have these strategies in your portfolio? And the answer is, I have no idea. And so I don't ever want that to be the case with my client. If an opportunity set exists, that's great. And then we say, what's the best way to access that opportunity set? If markets have sold off 35% and you want pure beta exposure, an alternative investment is not the best way to get that. Go buy an index fund, get your beta exposure somewhere else. If there's, a huge misalignment of prices in distressed debt markets and things like that, well, an alternative vehicle is probably the most suitable way to get access to that, because you want a manager who understands all of the covenants and things that go along with those complicated debt agreements. And so it's not alternatives for the sake of alternatives. It's alternatives because there's an investment opportunity, and an alternative vehicle is the best way to get you access to that investment opportunity.
Well, Doug, I think that's a great note on which to wrap things up. We did say we'd keep it to 45 minutes. So I hope that our attendees will join me in thanking Doug Coursen and Jim Baird from Plante Moran for a fascinating and insightful discussion. Gentlemen, have a great weekend.